Life insurance. Should you use it in retirement? Well, if you think it doesn't apply, you need to listen to this because it could help you with retirement income, long term care, and legacy planning. Listen to it all the way through.
We hope you've been enjoying all the episodes from Secure Your Retirement. If you'd like to keep learning and receiving these episodes, hit the subscribe button and the bell so you receive alerts when they come out. We've helped thousands of listeners get on the path to securing their retirement. Now it's your turn. Let's dive in.
Welcome, everyone, to Secure Your Retirement Podcast. We are super excited today. Merce and I, we work sometimes to try to get individuals that can come on and talk to us as well as talk to our clients. And today we got a very special guest, Jim Bowman, who is someone that we partner with and have known for a long time. And he really helps us and be ready, I guess you might say, for helping our clients with a very unique type of investment. I say it's unique because a lot of people don't think about it as an investment, but with life insurance, and he's a true life insurance specialist. So Jim, first of all, I just want to say thank you very much for coming on the show.
Well, thank you for having me. I'm honored to be here with both of you. I enjoy our company and our conversations over the years about how you help your clients. And so asking me to be a part of the show, it's an honor. So thank you very much for having me.
Excellent. So here's kind of the reason why we wanted you on. We know, as being in the world we're in, we work with individuals that are, most of the time 55 years of age and older. And so we help them in a lot of different ways. But one of the things that we talk to our clients and prospective clients about from time to time is life insurance. Now, a lot of times when I bring that topic up, Jim, what happens is I say, hey, let's talk a little bit maybe about life insurance. And the first thing somebody says to me is, wait a minute, Radon, I got the house paid off. The kids are raised. I got money in my 401k. I got money in my IRA. I've got a brokerage account. We're set. Why would I have life insurance? Because in my mind, life insurance is what I do to protect those debts. And now here you're talking to me about life insurance. So how would you help our listeners think about why would we even bring it up?
Well, it's a great question. And I think that's normal for your clients to think that, right? Because they've always looked at life insurance as an expense. They don't look at the value it brings to them and their family. So a couple of things. The first is when your clients talk about a 401k, for example, 401k really is just a section of the Internal Revenue Code. It says that, hey, you can put away money tax deferred, let it grow, and then you pull it out and then you pay taxes on it. It's not a marketing name. That's the Internal Revenue Code, 401k or 401. But now for life insurance, there's another section of the code, Section 72. And what that says is, hey, you can put away money after tax. It can grow, and then you can borrow your money and never pay any income taxes or capital gains on that. So it's a unique thing. The life insurance industry doesn't like that you say it's an investment, but it can be a great enhancement to your portfolio. So that's number one. The second thing is I'll just say this, people buy life insurance for one or two reasons and one or two reasons only in my career. They love somebody more than they love themselves, so they want them to have a quality of life after they're gone, whether it's leaving an income for a spouse or for the next generation. You want them to have a better start to life than what you had. And that's a great way to legacy plan. And then most recently, the last 10, 15 years, long-term care. There are so many advantages to having life insurance with long-term care riders or even annuities with long-term care riders. So that's really become great in the planning process for your clients. So I think over 55, everybody should be considering life insurance in their financial plan.
Yeah, that's a great point, Jim. And, I think a lot of people, when they think about life insurance, going back to what Radon said and what you just said is, it's a nice way to legacy plan. I want to leave some money behind, and the biggest benefit I think is that it's tax free to that next generation, right? So legacy planning is huge for a lot of different reasons for people, and let's just leave it at that and say, one strategy is legacy planning. When I pass away, I need to take care of my spouse. I need to take care of my kids. I want to create this multi-generational wealth. And so, say you have someone that doesn't have that desire, and they really want to be focused on retirement planning. And you just said it, right? It can grow. You can grow. You can look at this as an investment vehicle. So, help our listeners kind of understand. Well, what does that really mean? How can life insurance operate as an investment vehicle for retirement planning tools?
Great question. So, like, I'm going to explain it through a story. Okay. And I'm just going to assume, let's say the three of us are going to build an apartment building. And we're going to build a 5-story apartment building, right? And so day one, year one, what is that? Well, we got to go find the land and we got to purchase the land. That's an expense, okay? Even in year two, then we got to hire a contractor. Then we've got to build, buy the materials, everything else. The first 2.5 years is nothing but expense because we got no revenue because we got no renters, right? Now, let's say year three, we've got all 5 stories built and we're starting to bring in some revenue. And let's say we get 25% occupancy. Okay, our expenses are down, but now we've got some revenue coming in. And let's say by year 5, we're at like 85, 89, 90% occupancy. So that's all revenue. Now, our major expenses are all gone, but we do have ongoing maintenance expense for utilities, for the grounds, for taxes. So our expenses are down significantly, but we have an ongoing charge. That's exactly how life insurance works. You have a lot of upfront expenses to cover the costs of the underwriting, commissions paid, all in that first couple of years. And then after that, when you have gains, there's very minimal expense. So long term, this is an unbelievable asset to own. It's unbelievable, and it's a low cost if you own it and do it for the right reasons. And if you have it 20, 30 years, it's going to be less than a percentage point of overall cost. And you get all the tax benefits of being able this money to grow tax deferred, and you get to pull it out tax free. There's no other asset class that can do that. None. And in addition, you'll get a legacy play, a death benefit on top of that. And depending on the contract, you may even get some long-term care benefits. So there's some real advantages to using this to supplement, or for business owners who don't have a 401k, for this to be the retirement plan. And we see a ton of people who use life insurance in this capacity.
So let's just back up here for a second and kind of baby step our way into this, because we jumped into this idea, because I think for a lot of listeners, whenever you're younger, you might go to work somewhere and you get life insurance. And typically, if I've got a house or I've got some debts that I'm trying to cover, I'm going to get term insurance.
Yep.
Mm-hmm. Term insurance is where I'm just buying the insurance, and most times I'm never going to get a death benefit. I hope I don't. Right. So when you talk about this idea of like having cash accumulation and all these benefits, are you talking about term insurance?
So no, good point. So the term portion is really, I recommend term for those, hey, I'm just starting out. I've just like for my son, we just had our first grandchild, right? So they need to have term insurance. God forbid he passes. So his wife and the baby can have a good start and replace their income. Okay. But beyond that need, if you have a desire to supplement or build a retirement income plan that's not subject to taxes, there's no better vehicle. Because to be honest, we don't know what tax rates are going to be in 15, 20 years. And especially for your younger clients, 30, 40, 50 years from now, what's the tax rate going to be? Even for your clients who are 65 retiring, what's the tax rate going to be when they're 80? So I love having a portion of your retirement plan in a vehicle that is not going to be subject to income tax or capital gains taxes.
So again, I just want to make sure that you're taking everybody along. So basically, what you're talking about is what I guess we would call cash value life insurance, meaning it's going to have a cash value to it. And I know you just did a very nice analogy around the house and the expenses and all that kind of stuff. So let's just take it through so that I think for the client who's listening, because I'm going to have what's going to be called legally a premium going into this policy, right? So when I put money in there, premium to me sounds like all expense. So Can you just kind of help walk through, like, if I said I want to put X amount of money into this life insurance. How's it going to work so that all of that's not just going to true premium, that I'm going to actually have access to some cash?
That's great. And so I'll try to break it down really simply. So, and this is based on the Internal Revenue Code. Okay. So term insurance is all expense. Okay. And when you want to maximize your death benefit, you want to pay as little premium as possible. Well, what we're talking about is going to be the exact opposite. What I want to do is pay as little money for the cost of insurance and administrative of the policy. And every dollar above that, I want to go into a vehicle that's going to be able to grow, whether it's an indexed product, whether it's whole life, whether it's a variable life contract. Like every dollar above that then goes in, and I'll just use an index universal life, for example. So let's say we're putting in X dollars. X plus 1 will then go into the index account. And whatever that index account gets is going to be the return on those dollars in that account. And that's the, investment portion of life insurance. And when we design this to really minimize the amount of life insurance we buy. And this is really telling. The Internal Revenue Service has a limit on how much you can put in based on age and how much insurance you buy, because they understand that this is a pretty cool vehicle and they really want you to do this to supplement retirement. Life insurance is really one of the government's way of saying, hey, here's a way we can help you take care of your family and yourself without us being involved from a tax perspective or having to write checks from the government. So does that help a little bit?
That helps a lot.
Yeah. So let's take, for example, Jim, like I don't know, a small business owner. He's got excess cash every single year, and he's listening to this right now, and he goes, I really like this idea of building, it's kind of the Swiss Army knife of, hey, if something happens to me, there's tax-free money to my spouse, right? Retire, I've got this growth vehicle now, this investment vehicle through life insurance I can utilize for tax-free benefits down the road. And then we'll get to long-term care as well. So it can do a bunch of different things for me. I want to go fund this. Is this a forever type of funding situation? Or in your opinion or your experience, what's the most effective way to kind of set these plans up and to get that cash value rolling for you?
So for a business owner, we try to mirror that with what their game plan is. Are you going to be in business for 10 years or 15? We want to try to mirror that work path life with how much they want to fund. For some of your other clients who maybe are, 55, 60, 50, it's like, hey, we're only going to work like the next 5-7 years. All right, we will do that and put it in over a 5-year or a 7-year period. And again, the Internal Revenue Service has rules on this. Like we can't put it all in 1 year and have it be a true investment and not be taxable. They're going to say it's called a modified endowment contract. And so we want to avoid that so we can get the most tax advantage thing. But it really comes down to a conversation with you and your clients is what's the goal here and how long do we have this money coming in? All right, we want a portion of it to go here. And I'll say this, and you guys are great planners. We don't want all of our eggs in one basket. This is part of an overall strategy because this is structured properly is not a high risk deal. You may want other opportunities to take on some risk or try to get more in return. That's taxable. This is, as I say, I love to have a tax-free bucket as part of my portfolio.
Yeah, because I think one of the maybe misconceptions or however you want to shape it is, I don't want life insurance because it's a cost, right? Term life insurance truly is a cost. And do I want to pay that for 20 years or the 10-year term that I'm buying with no true benefit to it if I stay alive, right? I lived, but I didn't get the use of the life insurance that I paid for it. But with cash value life insurance, kind of the way that you just structured it is, well, it's a 3-year, a 5-year, a 7-year, a 10-year commitment, and it's not all cost. And then you get this train rolling. And a lot of times you hear people say, I've got this policy that's paid up, right? Can you explain what that means?
So it's a term that's probably very easy to misunderstand because it's not used the same by everybody. But paid up technically means you have no more premium payments due on the contract, and it's going to endow, meaning how much you bought for death benefit will be available at a specific age. And that's more like a whole life term. And there's great whole life contracts. I'm not one of those people like I only like one type of permanent. I kind of like what fits the client's strategy, methodology, philosophically. So paid up means you definitely don't have any more premiums that are due.
Mm-hmm. Okay.
Yeah, and so I tell you what, just so we can make sure we get this into our conversation today, because we kind of talked about it a little bit. So I'm going to sum up where I think we are on this. The idea is I could have in my, I call it the cash bucket of the policy. I could have a substantial amount of cash there that I would have access to in the future, tax-free, without having to pay any taxes on it. So I could actually create an income stream out of this bucket. Is that right?
Absolutely. Absolutely correct. And the other thing that, and you were probably going there, Radon, so I apologize. But the other thing is, like your 401k, your qualified plans have rules. Like you can't touch money until 59 and a half. You have to start taking money at RMDs at, I don't know what age it is now, 72, 73, whatever it is. This cash bucket that you talk about has no rules. Like I can tell you from my own account, I had an opportunity to buy into a business and be an investor. Well, I didn't want to liquidate anything else. And so I went and took a loan from my cash value. It's an index universal life contract. I took a loan from that and the money was there. And I used that to be partners in this opportunity. Now I'm paying myself back. I'll pay that money back over time, but it was a pool of cash I could use. And, whether you're 52 or 42 and you want to use it to start up a business, it's there for you. And that's another real advantage that people don't always think about. It's the access to the liquidity when you want it too.
Yeah. So let's just transition here just so we can, I want to get this topic in because it's a big topic for us as well when we're talking to clients. So we talked about in the very beginning that you can add to these policies a long-term care benefit. And the reason why I like this, and I just want you to kind of maybe help our listeners a little bit, is that with the old traditional long-term care, we've got some clients that have these policies that they've had for many years, and they had it, and now they're getting like rate increase after rate increase, and they're going, should I still do this? And that's the old traditional. And so with life insurance, I can attach to it a long-term care benefit. So can you walk through what that looks like and some of the benefits of why somebody would do that for their long-term care planning?
Yeah. So because, and I will say this, the industry, when individual long-term care policies came out, they made some assumptions that were wrong, which has generated all these increases because people thought they wouldn't hold these policies forever. Well, why would you not hold on to a long-term care policy, an individual contract? So that has really generated a lot of the reasons for the rate increases. So what's happened is we've decided with the help of the IRS, decide that we can go and tap into the death benefit and use that prior to somebody dying to pay long-term care medical expenses. So so there won't be any rate increases because what you're doing is accelerating what you've already purchased. Let's use it's $1 million. Okay, I bought $1 million death benefit. I can't do 2 of 6 of the activities of daily living. That's what it takes to trigger being able to access the money. And then you're going to be able to access, depending on the company and their contract, a portion of that death benefit over the next 4 years. And the typical client needs long-term care coverage for about 4 years. And that will all be dispersed to the client or to the owner of the contract tax-free. It is such a simple way to help address this huge problem that the country has for long-term care benefits. And I want to applaud you guys because it's probably about a little over a year and a half ago when we sat down and talked about, hey, we want to incorporate more, and you guys have become experts in long-term care. So I applaud you and what you're doing for your clients.
Yeah, so I think it comes back to this idea of like this Swiss Army knife tool that can only help you. It can only help you as long as you understand the nitty gritty of the funding rules and not overextending yourself by saying I need to go get a $10 million policy. Right, there's that you're going to be paying premiums into that. Right, so part of this is proper planning and kind of seeing how it fits into the plan itself. And we always talk about, take like a high income earner that is not close to retirement. And they say, hey, I've maxed out my 401k, like I was told to. I built up my emergency fund. I've funded a taxable brokerage type of account. And like, what do I do next, right? Often the next step is, I would say, put this into a different type of strategy, which is, well, you could choose to fund life insurance, right, for a retirement vehicle, for a long-term care planner, and then take the retiree that's no longer making income. And let's talk about this one, because this one, we've got plenty of clients today that are forced to take that required minimum distribution. They don't need it one bit, right? And so how is that strategy utilized? Say I've got someone that has a $50,000 RMD, required minimum distribution, that they don't need, and they like the idea of long-term care. They like the idea of leaving some tax-free money behind. How does that work in your world?
So I that's probably the bulk of what we do is with retirees that have money that I'll call it never money, forever money. They don't need it. How do we put that money to work for them? Well, I love the life insurance for a legacy play, and we'll talk a little bit, but it's really, I'm buying it for the long-term care, because the individual, products, as we talked about earlier, aren't really good for clients, in my opinion, today. So if I can move taxable dollars, because they're tax-free, you got to pay taxes, and then if I can put them in a vehicle they're never going to get taxed again, that's a home run. And if it can do three things for me: it can grow tax deferred, and I can pull it out tax free. That's number one. Two, I can leave a legacy. I'm going to get more out to my loved ones, or a charity. You can use it for charity. And then I can get my long-term care coverage. I can have a pool of money set aside for long-term care. So if clients don't need the money, there is no better place to start putting it to help you from a long-term care perspective, your family, and then from a tax perspective. I think it's a great strategy. And I would encourage clients to reach out to you guys and just have a report done on, I'm sitting with $1 million, $2 million, $800,000 that I'm never going to use. Realize what the tax liability is that over their lifetime. And you guys know how to show them that. And then say, okay, if we move this, a Roth, or life insurance would be kind of a Roth on steroids, in my opinion. What are the other value benefits that they could get? And you guys can show that on paper. So I would encourage everybody listening here, if you've got a qualified account that you're not going to need, or a portion of it you don't need, to sit down with Mers and Radin and take a look at this as an option.
Yeah. Well, I tell you, we could probably sit here and talk all day about this, but we felt that this was a beneficial topic, and we appreciate you taking out time from your schedule to come and help us get a little bit more clarity. And I do want to just say, I know you just said it yourself, but if you are listening to the podcast and you're thinking, man, I just don't maybe completely understand what they're talking about, it's very easy. Just go to our website, pomwealth.net. Go to the Contact Us page and just say, hey, I want to have a conversation. I want to see how this may fit or not. And we're glad to show anybody how this could potentially work for them. But thank you very much, Jim. We appreciate you coming on the show today.
Oh, my pleasure. And good luck to you guys.
We hope you have enjoyed this episode of Secure Your Retirement. If you would like to learn more, we have actually created an online course called 3 Keys to Secure Your Retirement. This video course helps you to think through all the different steps as you get ready to plan for and live throughout retirement. You can access this by going to our website, pomwealth.net. In addition, you can also subscribe below to our podcast called Secure Your Retirement.
For more retirement tips, check out these videos. Also, if you find them valuable, please subscribe to our YouTube channel and give us a like.